Welcome back to The Explainer. Today, we're tearing into a highly complex, honestly, often misunderstood area of institutional finance. We're talking about the strict reporting framework surrounding international scholarships and research grants. We've got our hands on a remarkably detailed, anonymous expert report, and we're definitely not just going to skim the surface here. We're acting as an analytical engine today, diving deep into the core mechanisms, the implicit assumptions, and those hidden cause and effect relationships that truly govern cross-border academic funding. If your institution handles international scholars, or even if you're just fascinated by the intricate architecture of international financial compliance, this analysis is going to equip you with some serious, expert-level insights. So let's jump right into the data. To kick off our deductive analysis, we really have to tackle the foundational question that dictates literally all subsequent compliance protocols. What actually determines the tax jurisdiction of cross-border academic funding? Now, this isn't just some minor administrative technicality. This is the fundamental trigger for the entire regulatory ecosystem. Think of it like the first domino. If you misidentify the jurisdiction right out of the gate, every single downstream calculation, from coding to tax withholding, the whole shebang will be fundamentally corrupted. We have to strip away our assumptions here. Forget about where the student originally hails from or what specific global currency is being used for the wire transfer. We need to look strictly at the underlying legal mechanisms of the transaction. Getting this wrong exposes institutions to some absolutely massive compliance liabilities. Section 1. Principles of income sourcing. Okay, here is the explicit rule that guides this entire framework. The jurisdiction of academic funding, and that includes scholarships, fellowship grants, targeted research grants, achievement awards, is strictly determined by the payer's residence. Now, I want you to really think about this for a second, because it completely defies common sense for a lot of people. Naturally, you'd think the destination of the money matters most, right? But in cross-border reporting, the analytical anchor is exclusively the residence of the entity actually writing the check. This means that funding paid by domestic entities, domestic trusts, or domestic states is inherently classified as domestically sourced. It doesn't matter if the recipient is a foreign national living halfway across the globe. It doesn't matter if the funds are wired directly to an international bank account in a completely different currency. The strict legal origin point of the capital is what counts. This is the absolute default setting of the cross-border reporting apparatus. Moving right along to Section 2, the foreign activity exception. Now, the matrix you're looking at here perfectly reveals the explicit cause and effect relationship when these standard rules collide with real-world complexities. Take a look at the bottom row. The exception flips the classification entirely on its head. If the funds are received by a non-citizen and the activities, like the field work, the lab research, or the actual studying, are conducted entirely outside the domestic borders, the income source logically shifts from domestic to foreign. This is a crucial legal mechanism, and it's designed specifically to prevent jurisdictional overreach. It structurally acknowledges that, sure, while the money might originate domestically, the economic reality and the physical execution of the activity are entirely foreign. Identifying exactly when this exception applies is a paramount, highly actionable insight for any compliance officer. It's how you minimize unnecessary reporting burdens and avoid taxing income that legally falls way outside your purview. Section 3. Categorizing academic funding. Notice the overarching category we're dealing with here, FDAP. That stands for Fixed, Determinable, Annual, or Periodical Income. What's absolutely fascinating here is that academic grants share the exact same fundamental tax classification umbrella as corporate dividends and intellectual property royalties. You might be wondering, why on earth is that? Well, because the structural mechanism is identical. They are all considered passive income streams paid to foreign individuals or entities. They are entirely separate from traditional active wage labor where someone clocks in and out. Understanding that a prestigious research fellowship is structurally treated by the tax code exactly like a standard corporate dividend payment, that's a massive paradigm shift. It completely changes how you need to approach the reporting rigidity and the strict compliance protocols applied to this money. This structural classification is absolutely essential. you literally cannot understand the eventual reporting exemptions without first deeply grasping this FDAP categorization. While general FDAP includes your standard corporate dividends and banking interest, academic FDAP is uniquely characterized by its conditional nature. We're talking about taxable scholarships and research fellowships that are governed by incredibly specific statutory reporting requirements. There's a big implicit assumption a lot of people make. They assume that educational funds get some kind of free pass from standard financial reporting just because they serve a noble academic purpose. Well, this expert analysis proves that assumption completely false. Make no mistake, these are highly regulated financial transfers subject to rigorous institutional scrutiny. Let's dive into Section 4, Reporting and Coding Mechanics. According to the reporting frameworks, every single dollar of domestically sourced FDAP income paid to foreign recipients has to be meticulously documented using these specific data points. And here is a deeply important, non-obvious detail we pulled from the expert reports. Unlike domestic information reporting, which often features these minimum dollar thresholds before filing is legally required, cross-border FDAP reporting generally has a $0 threshold. Let that sink in for a moment. If a single dollar of domestic source FDAP is paid to a non-resident alien, it must be reported using these exact structural identifiers. There is absolutely no materiality exception here. This $0 threshold is a major warning flag for compliance officers. Why? Because it means even the absolute smallest supplemental grant or travel reimbursement categorized as FDAP triggers full, comprehensive reporting obligations. Within these standardized coding matrices, we arrive at a very, very specific mechanism: Income Code 16. You can really think of this two-digit number as the secret key to the entire system. It is the highly specific, completely non-negotiable designation utilized strictly for scholarships and research fellowships. It's the analytical linchpin. It tells the massive regulatory database exactly what kind of academic FDAP is being processed, distinguishing it clearly from royalties or dividends, and unlocking the specific rules that apply only to educational funding. So the crucial point here revolves around a very non-obvious detail. Standard cross-border forms universally demand a foreign address for a foreign recipient. It's a built-in logic check, right? It's there to prevent fraud. However, Income Code 16 specifically bypasses this rigid requirement. It intentionally allows a domestic address to be logged for a foreign recipient. And you have to ask, why make that exception? Well, because the system's architects implicitly understood the physical reality of academic funding. Foreign scholars are almost always temporarily residing domestically to conduct their research in physical labs or to attend classes at their host institution. Code 16 provides the structural anomaly required to make this incredibly strict reporting database actually reflect the physical, lived reality of the scholar on the ground. It's a really fascinating workaround. And that brings us to Section 5, Managing Withholding Exemptions. This sequence perfectly demonstrates the strict, logical dependency required to process an exemption. Honestly, it operates exactly like a computer algorithm. You absolutely cannot skip to Step 4 without meticulously verifying Step 1. You must first establish the gross income, then verify the absolute absence of any overriding centralized agreements, logically apply the precise withholding allowance, and only then dynamically calculate the final net income. I know it's tempting to just jump straight to the net income to save a little time, especially during those crazy busy academic onboarding seasons. But doing that without following this strict sequential logic on the reporting forms, that creates an immediate structural anomaly. And that anomaly is going to trigger automated compliance flags and potentially trigger painful audits. Don't skip the steps. This is where the micro-level reporting directly connects back to macro-level international geopolitics. Exemption Code 04 isn't just a simple data entry choice on a spreadsheet. No, it is a profound legal claim. When a reporting entity utilizes Code 04, they are explicitly invoking a bilateral international tax treaty to lower or completely eliminate the withholding burden on that specific scholarship. It is the exact mechanism that translates a high-level diplomatic agreement between two sovereign nations into a concrete, usable financial benefit for the individual scholars sitting there in the lab. But, and this is a big but, invoking it requires absolute documented certainty that the treaty actually exists, that it remains currently active, and that it legally applies to the specific recipient based on their individual tax footprint. It's a heavy responsibility. As we wrap up our analysis of this expert reporting framework, we want to leave you with a critical question so you can evaluate your own institutional protocols. We've mapped out the hidden cause and effect relationships today, starting from the initial jurisdictional sourcing of the funds, straight through that rigid FDAP categorization, all the way down to the physical anomalies of Code 16 and those massive geopolitical treaty invocations of Code 04. The mechanisms are strict and the implicit assumptions are deeply, deeply embedded into the very architecture of international finance. So ask yourself right now, is your institution's data matching this rigorous structural reality? Thanks for joining me for this explainer. Keep analyzing, keep questioning, and we will see you next time.